It'll be 5 years in 25 days. So pretty excited about that. But started out, I was all over the place, right? Didn't know what I was doing. I was just following everybody. I was just like, I just thought it was just a quick get, rich scheme. That's all I thought it was. And, until I lost a boatload of money. And until I was like, hold on, there's got to be a way that people are making money and doing this for a full time. And so I knuckled down. I stopped trading for almost 6 months and I went to work. I read as every book I could. I started learning charts, candlesticks, lingo. I started back testing people's strategies and I eliminated the noise. And it took me almost 2 years before I finally got out of the negative to where I was starting to be positive. And then it took me another year and a half before I became six figures. And then from there, it's game on. So I am big in humongous in risk management and protecting your capital. You do not win all of your money on one day. You have 252 trading days. You don't have to trade every day. So I have 14 weeks of boot camp to get you in the best mind, physical, and execution shape so that you can trade profitably. So, small backstory of me. We'll get started. This is week 1. Okay, so this is for you to understand the basic options and market terminology. Okay, this you might know all of it, and some of you might go, "Oh, I didn't know what that meant," and it might catch you there, and that's what I'm looking for, right? It's about 35 minutes. It's something that I want you to just take notes. We're going to have, my expectations in a second, and at the end, we're going to have a scenario for you to talk it out with me. Okay, so pretty excited about it. Can't wait, and we'll have one every week. Okay. So in this introductory section, we're going to practice on just understanding what an option means. Look, what's a call? What's a put? What's a strike price? What are the key stock market terminology? What do I need to know day one so I can just some expectations for you guys so you can do it, right? Just try to be here early, right? If you be here early, you'll never have to worry about being late or coming in crazy. I have a a great little motto that I teach my kids is that I would rather be early and wait than rush and be late. And it's just one of those things, right? Also, try to pick a place that's quiet for you to listen, right? I want you to be distraction free. You don't want to have, your family or friends or you're outside on the street or something. Try to stay locked in, right? Just respect everybody. If you can just respect your time, if you could stay muted, that'd be really great. If you could just jot down your questions. At the end, I will answer all of them. Try to be present, try to be engaged, right? This one might be easy, but week 4 might be really intense. And you'll be like, okay, that was a lot more. And just remember, it is adult energy here. You might hear some cuss words, some shit or something. We're all adults here. I don't want you to feel like it's not. So just want to kind of give you a good indication of that. Now, let's get into it, right? What exactly is the stock market, right? In definition, it's just a marketplace where shares of public companies are bought and sold. And now, where are the shares sold? They're sold on exchanges, right? An exchange is a place where different investors can decide. So, for an example, 2 big ones are the New York Stock Exchange, where majority of where we're going to be doing our trading, and the NASDAQ, right? There are other ones out there, right? But the main ones that if you just want to learn and you understand in the New York, stock market, that's where we are. So let me make sure I got that. Okay, good. We're good. I just want to make sure. Now, key concepts for you to understand, right? There has to be a buyer and a seller. A trade will never occur between a public company unless there is a buyer and a seller, okay? If I'm selling some wheat and someone wants to buy my wheat, we have to come to an agreement before we exchange that. So I'm just exchanging things. We have to come to an agreement. So just remember that, okay? Turn my fan off. It seems a little loud. Now, there are other examples, places that you can look at into buying. S&P 500. This is where it has 500 companies being together. Dow Jones, NASDAQ. Again, just think high level of where we're at. Now, one of the important things is during the stock market, there are only certain hours of the day that you can do certain things, right? there are, I want to make sure my stream is still there. Okay, good. Pre-market, right? So from 4 a.m. to 9:30 a.m. Eastern Standard Time, you can buy and sell shares. You can buy Ford, you could buy Tesla, you could do whatever you want. Shares, okay? So you can get in at 4 a.m. at $8 for Ford and sell it at 8:30 in the morning at $9 and make your dollar off your share. You can do that all the time. Now, when the market opens at 9:30 a.m. Eastern Time, that's where everything becomes fair game. That's where the options come in, and we're going to explain what options are. The market goes until 4 p.m., and the market then has a post market from 4 p.m. till 8 p.m. This is just a basic standard of the day. I'm pretty soon at some point it's going to have 24 hours, which I think some kind of companies and brokers are going that direction. But just to give you an idea, the main thing to pay attention to is the yellow, the market hours, 9:30 to 4. That's your bread and butter game jam. When I first started and I started to pick up before I got into options, I was doing the strategy where I was buying shares at 7:50 at night and I would sell them at 4:02 in the morning because I was trying to get around the PDT item where you could only trade 3 times a week because they didn't really have cash accounts back then. It wasn't really up and coming until now. So I was able to trade every day. I would just buy on Friday night, sell on Monday morning, and I was starting to pick up the pace. And I did pretty good with that. I was doing with penny stocks, all different type of stocks, but it was easy for me. I would either do good or I would lose, right? It was like boom, boom, and it was pretty easy to see, but I could do it because it was a very simple strategy. So if you're someone that likes shares and you want to do that, it's a great way to get around it. Buy it at 7:50, sell it at 4 in the morning. It doesn't count as the same day. It's great. It's freaking great. So just kind of something that if you're ever into those type of deals, I got plenty of other things to help you with. And then, of course, just an example like what's traded on there. Apple, Tesla, they're on major exchanges, i.e. the New York Stock Exchange. Okay? Now, let's keep going. We got a lot of good stuff. Now, you got to pay to get into it, right? But you need a broker to do it for you. Now, to get into exchange, I can't just go up to the exchange in New York and buy it there. I have to have somebody go do it for me. That's where brokers come in. That's where you've seen commercials where you've had Robinhood, Webull, Thinkorswim. You could have seen it and not realize what it was, but a broker is just a middleman for you to help you buy and sell these securities, right? Now, when choosing a broker, just understand there's all sorts of ones out there. There's ones that have fees, platforms, tools, ones that give you real-time data, paper accounts. They can deposit fast or slow, whatever it is. But for an example, to make it simple for you, for most beginners, they either start with Robinhood or Webull, right? These are great platforms to begin with. They're very user-friendly. They're good on your phone. There's nothing crazy. If you guys have never tried it out, we have a referral link. We'll send it to you. You get 5 free shares or depending on whatever you deposit. So just think about that. These are definitely places that you need to start with. You got to decide on your broker. I won't tell you which way to go, but most people will start out there and then migrate to the advanced ones, right? Webull's really good. I started with Robinhood. I am 100% on Webull. I do still have Robinhood. I do it mainly more for helping other people because I want to have other options, and that's pretty much why I still have Robinhood. But I like Webull a lot. There's also charting platforms. It's kind of more advanced. We'll talk about that in later weeks. But TradingView, I really love TradingView. It's great for charting and other things. But Webull has a great TradingView as well. So we understand what the stock market is, just a place where buyers and sellers can come to an agreement. You have to have a broker to get into the game. Okay? Now, let's talk about the options, right? So you can buy and sell a share all you want. Cost you $100 for a share. Cost you $100 to get in, you own 1 share. Now, an option, right? An option is pretty cool because it's a financial obligation, or not an obligation, that allows you to buy and sell at a specific price before a set date. So for an example, if I think Tesla is going to go from 320 to 340, I can say, you know what? I want to buy the 340 calls. I think I'm going to get up there, and I can do it by a certain amount of time frame. And we're going to go into detail on that. But basically, it just allows me to say, you know what, I think it's going to rise to this price, and I'm going to get in for just a premium. Instead of having to pay $320, I might pay $470 for 100 shares, and it allow me to move. We're going to go into this, so don't worry. So two type of options. We have a call, which allows me to buy, and we have a put, which allows me to do a sell. So if I think it's going to go up, I'm going to take a call. If I think it's going to go down, I'm going to take a put. And remember, options can only be done during market hours. You got to remember that. So from 9:30 a.m. or till 4 p.m. Eastern Standard Time, whatever the hours are for you, shift it to your time. That's the only time you can buy an option for your stock that you want to play in, right? So again, it's an amazing tool because it allows you to maximize your money. So instead of you just owning one share, this other way called options allows you to maximize your money. So that one contract you have that, yes, it might cost you $400 a contract, could triple in an hour, where it tripling from 320 to 900 might take 3 years. So it's impressive, the power of an option. So let's keep going so you can kind of understand. I'm going to show you an example of what an option screen looks like on both Webull and Robinhood. So for an example, and again, I'm going to go into massive detail in the few weeks on explaining every single thing on this screen, okay? But just for future reference for yourself for that example, Tesla's at 320. I wanted to buy the 340 calls. And let's say I wanted to do it expiring 5 days out. It would cost me $470 just to get into the play, right? $470. If that thing moved towards that direction, it's going to gain premium power. It's going to gain more money for me. So it might be 470, it might be 500, it might be 525. And you know what? At 525 and I made $50, I might be good, but you can sell it and there's nothing wrong with it. You sold it at 525 and you're out, and you just made $50, $55, right? Now, it has just the other way of going the opposite, right? If it goes from 320 down to 315, your option is going to decrease in the other direction. And it all depends on time and a lot of other factors that we're going to talk about. But I just want to give you an idea of kind of what an option screen looks like. Again, future weeks, I'm going to explain this in detail, absolute detail. But as you can see, if I didn't want to take a call and I wanted to take a put, and maybe I think it's going to go to 300, I'm going to pay $330 for it. And you can see that's where I'm going to go to. Okay. Now, same thing on Robinhood. Very, very simple on Robinhood. It's not overcomplicated. There's the only thing you're going to be doing is buying a contract. You will never be selling. We don't do naked calls. That's a totally way advanced type of deal. You're going to be buying an option, and after you purchase it, then you'll sell the option. You will never first sell a call or sell a put. You have to buy it first, have the contract, then you can get rid of it. Okay, this is the same thing. So if you look at this screen, it's saying the sell price for SPY is $505. We're currently looking at the buy side on the calls, and if I wanted to pay for the 510 calls, it would cost me $610. Okay, very simple for one contract. We'll get two, it's another 610, three, and so on. Okay, now the next few slides I'm going to talk about more of the terminology that will start to make sense from what you hear from me, McCroby, Texas, where they're telling you certain things. Okay, you might see his call out and you're like, I don't know what that means. This is going to help you understand. Okay, now the bid and the ask. Remember I told you have to have a buyer and a seller. The bid is the buyer and the ask is the seller. The ask always is high because they're like, how much am I going to get? And the bid is like, what can I lowball this price, right? So the bid is what is the buyer willing to pay, and the ask is what is the seller willing to accept. Until they come to an agreement, that's where you're going to have a spread. Okay, you want the spread to be as close as possible, and we're going to talk about that. So if the ask is $100 and the bid is $99, it doesn't hurt you just to take the $100 and get into the trade. If the ask is 100 and the bid is $50, probably hurts you to take the 100. Might be better for the middle. But there's a downfall for that spread being that big. We're going to talk about that in a second. So just keep that in your mind. Volume. Remember what you might have saw earlier. And again, this volume channel. This is how many contracts, one individual contract, has been open and closed in that trading day. Okay, it's impressive. Open interest. This is how many contracts swung from the previous day. Okay, so you're like, oh my gosh, there are 8,000 individual people that held from yesterday or from Friday or whenever they held it, rolled it into today, thinking that the stock is going to go from 320 to 340. 8,000. Okay, it's impressive. These are things will help you make better decisions. Like, whoa, there's a whole lot of money rolling to the next day. So pretty cool. Strike price. What do you guys agree on? Like, I think it's going to go to this number. That's this middle part, right? Whatever we think the strike is going to be above or below. Okay. And then we have the expiration date. How long are you willing to pay for this contract? The shorter the time frame, the kind of cheaper it is. The longer the time frame, the more expensive it is. But you can kind of be a little bit more loose with it, meaning you can go a little bit farther out. Let's say you go 6 months out, right? And you're like, I think SPY is going to go to $550 by the end of the year. Totally making this up, right? It's having a terror war right now. But let's assume that you're like, I think it's going to bounce back and I'm going to do that. You can go out 6 months and the 550 might be $1,000 a contract, right? But you're like, all right, maybe that I can't afford 1,000. Well, look at 575 might be maybe $600 and the 590s might be $300. And maybe that's a better number for you. And it's that $300 could turn into 1,000 as the months progress, and it might be worth your advantage. So think about your type of strategy as we get advanced into this boot camp. Okay? Other great things for you to know. In the money, out of the money. If you ever want anything to happen, I would love for me to buy a contract out of the money and it could become in the money. I never want it to be in the money and go out of the money. That means I am losing interest. So, for an example, in the money, the underlying stock is trading above the strike price. So, an example, ABC is trading at $30 with a strike price of $25. Means I'm in the $25 calls and it's trading at $30. I'm $5 in the money. I'm making a boatload. I am rolling, right? Versus a put, right? Same thing. I bought the $50 puts when it was maybe at $52, and now it's currently trending at $45. I'm doing fantastic. I am $5 in the money, looking good, looking great. Opposite. It's just the exact same opposite thing. So ABC is trading at $15. I think it's going to come up to $20, so I buy the $20 contract. ABC is trading at $75. I buy the put at $70. I think it's going to come down to $70. So the premium, like what causes that number? Like, why is it $450? Why is it $1,000? Why is it $50? The price, the price paid by an option, it's influenced by a lot of things. And I have other things to talk about it, but it's the stock price, time, expiration, and market volatility. There are a lot of things that the money makers make a decision on why that particular stock costs that price. And they're very smart with it. They've got the calculation down pat on why they want to put it at this particular number. Okay? Now, next couple slides, really cool. I like these are kind of my favorite slides because these kind of help you understand certain things that you may have not remembered. Now, remember we talked about the bid and the ask. The whole goal of when you're getting into stock is to try to find ones that are close, right? The whole main reason for it being close is that it allows you to get in and kind of get out. If the bid and spread is really far away, nobody's agreeing anything. There's probably a lot of volume with that stock, and it's probably going to be difficult to get out. So if you remember when I told you the stock was $100 on the ask and the bid is $50, you might get lucky and get in at $75, but it's going to be very difficult for you to sell it at $75. It's going to take a lot of movement to get you up into the money. So pay attention to the bid and the spread. So if you go back and look, see how these are $15, $10, $15, $15. That looks like this is normal for Tesla. It is a normal amount to be $20, give or take. Okay? If we look at SPY, look at this one. This one, oh, I apologize, it didn't have the bid, but at least you can see it on this screen. The goal is for you to get into a stock that has liquid. And we're going to talk about liquid in a second. So, bull market, when the market continues to keep making new highs. Bear market, when it continues to keep making new lows. Now, we haven't talked about how you actually get into an option. We have the stock market. I got a broker. I found the stock price. I found the call I wanted. I want to take it at $470. How do I get in? There's two real main ways to get in. You have a limit order where you say, I want to get in at $99. Whenever it decides to come to $99 or the seller decides to come to $99, it will sell it to me at $99 versus market will sell it immediately for you and will get you in, just get you into the market. So if the bid and spread is within $1, it doesn't matter about limit. Just get in the play. Okay? Now, when it comes to selling, you can either do one of two things. You can sell your limit at a number that you like. I'm in at $99. I want to sell at $109. You can put a limit order in at $109, and if it ever gets there, it'll sell at $109. Versus, you know what? I'm happy at 110 or 111. You can just market order, and it'll immediately sell it, and it might sell you at $109. That's fine. You just got out of the trade. So you have a strict way of getting in or an easy way of getting in. You have a strict way of getting out or an easy way of getting out. It is all your choice. I do market in, limit out, unless all of a sudden something is getting rough and ugly. Because I'm looking for particular numbers, 10, 20, 30%, and I'm good. I'm happy with it. And it has helped me long term because we're going to talk about risk. Now, good till canceled order. It's another option that you have. Most brokers have this, that I don't know if they will do it all the time, but if you, let's say you're in at $99 and it doesn't move all day. Sometimes it might not move tomorrow or Wednesday or Thursday. It just doesn't move. That's fine. My order is in. If it ever happens, it's good until I cancel. Most of the brokers will do it based on the day. It'll default at you only have until the end of the day for it to go, and it'll cancel it out. But there are brokers that will let it be there the whole time until it happens. So an example, if that you have that $100 and $99, you're like, you know what? I don't want to get in until it gets to $90. Well, you put it in at 90. Some brokers make you do it every day, but other brokers might allow you to keep it on there the whole time until it happens. Now, volatility, right? Volatility is pretty cool because it's just how fast is the stock moving up or down? Is there a whole lot of demand? Is there just a gazillion people pushing into this ticker? That's what's going to move this sucker. Just imagine everybody rushing to leave a leave a concert or something. It's just a rush of volatility versus everybody trying to get there early, and there's not a lot of people getting there early. Okay? Now, liquidity. Remember what I told you about that bid and ask. I like the liquidity to be as close as possible because I want to be able to get out of my trade. I don't ever want to be in a trade where I can't get out and I just keep losing money because nobody is taking my order. And that's the worst feeling ever, is that you're in this great trade. You're like, oh, the stock went from $8 to $15, but then all of a sudden it opens and it's knifing and nobody is taking your order because there's no liquidity. It's all gone. And that's what you don't want to do. So think about the stocks that you want to play. Pick the top 50. Those have liquidity, right? When you come across ones where the spread is very wide, you're going to have to go probably far into the money before you start to get kind of an easy in and out. And you'll learn that. The liquidity will help you down the road, right? Now, trading volume, we talked about that. It's the number of shares being traded in a day. Going long, right? I think tomorrow it's going to be an up day. So on Friday, I played calls. That's what going long means. Going short is the exact opposite. I think I played a put on Friday. It doesn't expire until maybe next week. And of course, I think it's going to go down. Okay? Averaging down, this is where, let's say you bought 10 contracts at $100 and you're in for $1,000. And let's say the contract is moved down to $50 a contract. It's no longer worth 100, it's worth 50, and you buy 5 more. Now you have 15 contracts with a total investment of $1,250. So you averaged your price down. What's good about that on some plays is that if it does start to work it back up, you will make your money on the money that you bought at $50, and you will start to earn your money back from the ones you bought at 50. So it's kind of like a good and bad way of doing it. I don't personally average down. I would rather just sell and just rebuy later when I'm good. If my current play goes south on me, I just get out of the trade. I'm not big into averaging down unless something is just like, holy crap, this is just a fake sweep. This is something I just missed and I want to average down. Absolutely. It has done. I have done that before. Now, here's my scenario for you wonderful folks. Okay? I'll give it a second for you to read the first part. You personally believe Apple is going to rise next week due to an upcoming product announcement, right? You saw it on the news. You're like, holy smokes, it's at $177. It's 3 o'clock on Friday. I have an option. I got a chance to get in before this rolls out on Monday. Now, you find the call option. The strike price is $180. It expires next Friday. The premium is $250. What would you do next? Do you buy it? Do you wait? Do you get 10? Do you say, that's too expensive? Right? What do you do here? And then I have other additional things for you to pay attention to. Is how much does this contract cost you? Right? If the premium is $2.50, what does it cost you? And then what price does Apple need to reach before you make a profit? Right? How do you determine that? How do you know if this thing goes up $3 if I'm going to make any money? What will happen if Apple is below 180 when it expires? And what is one reason the option price might go up before Friday? Is there anything that you can think besides a product that will cause an option to move? These are things that you have to think about on the dot when you're ready to go. You're like, I saw something. I can now do my due diligence. I look at the call screen. I'm paying attention. I like what this is. I'm going to take a call here. I like this. I'm going to get in for $250. I'm going to roll it to Monday. It opens up at $182. You're like, holy smoke, it's up $5. This contract is now worth $600. I sell. Right? That's option one. You're like, holy crap. Same thing. You buy it for $250. It opens up at $171. And now this option is worth $120. And you lost $130. It happens. You have to do those items because you understand your risk. But I just wanted you to see that this is the stuff that we are going to teach you. How to make quick decisions on this without saying if this is good or bad. To me, this is a great idea. If I know that there's a product announcement coming, I'm absolutely doing it. There are other reasons that I know. The factors of Apple. I can go back and look how many times the phone came out. What did it do when the phone came out? It rose every single time, right? Heck yeah, I'm going to do that, right? Because I've understood my due diligence, I took my time, and that's where I'm at. So